convene the Mendocino County Employee Retirement Association Board meeting into session, and I'd like to invite Quincy to lead us in the Pledge of Allegiance.
Ready, begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, thank you. This meeting is being conducted, in accordance with state's open meeting laws during the COVID situation. So we are meeting by Zoom, and public comment is welcome. Members of the public are welcome to address the board, and the information on how to participate in the Zoom meeting are on our website and on the agenda. Do we have any members of the public who wish to address the board at this time on non-agenda items?
No members of the public waiting to address the board.
Okay, thank you. All right, well then we're going to go on to the consent calendar, and we have the minutes of April 21st, 2021, the April 2021 retirement report, and the preliminary monthly financial report. Are there any items that people would like to pull for discussion? Okay, not hearing any. Then the consent calendar will be deemed approved due to the fact that no one objected to the consent calendar. So we're going to go on to item number 3, which is discussion regarding the historical benefit review project status report and project update.
Thank you, Chair Jurdy. The status report was provided as part of your packet. Progress has been a little slow, and to date we have completed 212 corrections, which represents 1.8 million in overpaid benefits to members and 800,000 so far in retroactive payments made.
Okay, do we have any questions on the status report? Okay, not saying, do we need public comments on this?
No public comment.
Okay, and I realize I skipped over roll call. Judy, do we need to do roll call officially, or can you record it?
You should take roll.
Okay.
So Ms. Shatmeyer, are you here?
Here.
Ms. Forrester is absent by prior arrangement. Ms. Cavanis?
Here.
Mr. Jurdy?
Here.
Ms. Smith is here.
Here.
Mr. Cromer? Mr. Shoemaker?
I'm muted here, sorry. Here.
And Mr. Anderson?
Here.
And Ms. Harris is here.
Mr. Jurdy, I would also like to mention that item 9 has been continued until next month.
Okay, and that's the appeal item, and it's been at the request of the appellant, correct?
Yes.
Right, thank you. Okay, well then it takes us to item 4, which is possible action regarding investment matters. We have our quarterly investment report summary, our investment report full report, and our investment performance report.
Morning, board. We've got Greg, Claire, and Hannah here this morning to go over both of the reports with you. They'll start with the quarterly and then follow up with the monthly. Go ahead and take it away.
Great. Great to see you all. We kind of have a lighter agenda with you today. We're going to go through and spend a little bit talking about capital markets, what's been going on. I don't know if you looked at the markets today. It's a pretty active day today in particular. But of course, we, as long-term investors, look at a longer time horizon when we're evaluating performance. So we'll spend a few minutes talking about capital markets, and then Claire will cover first quarter performance. Punchline is the numbers are very strong, and the investment program is performing pretty well right now. So with that, I'll attempt to share my screen. How about that? Is that working? Wonderful. Providing a little backdrop on what the capital markets look like through the end of March, we always look at this information, put the performance of the plan in context to help us decide whether or not things are operating well, because you have to know the environment you're in to make that assessment. What this chart shows is the stock market performance in yellow since the beginning of the COVID crisis, and we're comparing it to the tech bubble and the global financial crisis. And I think you've seen this chart a few times before, but a few of the big takeaways is that the drawdown in the COVID crisis, the stock market drawdown, was the quickest we had seen in a really, really long time, the fastest to the bear market. And then the rebound out was incredibly strong, largely because of the monetary and fiscal stimulus that has been provided to the capital markets. And since we got back to the where we started the downdraft, the stock market has continued to climb, and it did so during the first quarter and through April as well. So now you'll see in the yellow line here that the U.S. stock market is 20% higher than it was before this whole COVID thing started, which is really remarkable. Another thing to note on this is if you look at where we're at the bottom of this cycle, the bottom of the yellow line to the top, you'll see that those numbers are just eye-popping. And when we look at one-year returns right now, what we're really looking at is just the rebound. It's just the rebound and the acceleration up. The one-year time period ended March. The bottom of the stock market was like March 20th of last year. So when we look at numbers this time, they look abnormally large. Some returns are going to say 100%. And that's just because we're capturing that weird hockey stick rebound and not including the downdraft at this point. Naturally, you look at 3-5 year numbers, that all comes out in the wash. Now, the stock market has been doing really well. In the long run, it has to go back to fundamentals of the economy. It has to. The stock market cannot grow faster than the economy forever. Trees do not grow to the sky, right? So let's look at the underlying economy here. And you'll see that over quarter growth for things like GDP, inflation, have actually been quite strong. Now, there are a few reasons that's going on. Well, there's several reasons that's going on. People are going back to work. There's been a lot of stimulus affecting the U.S. economy, but also the denominator effect is happening here. Our starting point, when you look at a one-year, year-over-year growth of GDP, we're coming off a low bottom, and that is also true for inflation. So right now we're seeing a lot of inflation prints that are coming in pretty high. And part of the reason is things like problems with delivery of things like computer chips or lumber, stuff like that. There are certain aspects of the economy that there's not a lot of supply of goods. But so there's a lot to that. But another thing we have to look at is, okay, over what measurement base are we starting for? And we're measuring it from a point where inflation was particularly low. So we need to keep that in mind when we look at a lot of these inflation numbers. And that is largely why the Federal Reserve has seemed to be not as concerned about these higher levels of inflation. And keep in mind, they want inflation to be running north of 2.5% on a consistent multi-quarter basis before they start removing accommodation. That has been their explicit goal. Notably, later today, we have Fed meeting minutes coming out. So it'll be really interesting to see what the meeting minutes say and if they continue with that stance. Anyway, during the quarter, we saw a really big back off in long-term interest rates. And a lot of that had to do with the concerns about inflation picking up and that the Federal Reserve could be behind the ball in terms of dealing with inflation. So you saw in this bottom left-hand chart here, you'll see the blue line is the U.S. Treasury curve at the end of March. And compare that to the other lines, it went up a pretty good amount. It was the worst bond market we've seen in 40 years. So really big backup in interest rates. And a lot of it had to do with the perception of inflation over the long run. And that's kind of what's implied in the bottom right-hand chart here, where you see the 10-year real yield reflected by tips. Yeah, it went up, but it just went up a little bit. But that yellow line, the break-even inflation rate, that's what the market says it thinks inflation will be on average over the next 10 years. That went up the most. But keep in mind, it went up to a point where it still starts with a 2. 2 point something. And it's not going up to the point where it's 4, 5, 6. So we need to keep that in mind when you look at long-term inflation forecasts right now.
Hey, Greg, let me jump in and say that the Western CPI through April is 2.5.
Great. Yeah, pretty in line with other broad measures.
Yeah, it's definitely picking up over the last 30 days.
So on this next part, we look at GDP growth, and you'll see the big growth numbers for GDP coming out. And what that really tells you is the slope of this line. The growth rate is the slope of the line, right? If it's really steep, growth rate is sharp. What you also have to look at is the overall level of the line. So with GDP in the United States, at the end of the first quarter, we weren't quite back to where we were at the beginning of the pandemic. So a lot of the rebound is just getting us back to where we were before. And we expect to be back there during this quarter, the second quarter, but we're still not quite there yet. So the level is important as well as the rate of growth in terms of GDP. Now the consumer is really healthy right now. What we're looking at here is savings rates across aggregate. And what this kind of says is, if we were all just one human being, you look at all the savings, all the income in the United States and say, well, how much income do you have on average? And on average, we have a lot of income. We have a lot of money sitting in our pockets right now. Now, one of the issues is we know that it's not equally distributed, and some people are benefiting a lot from this economy while others are not, right? And some people, and you know, the stimulus package is there to try to address that. But if you look in aggregate, there is a lot of money in people's pockets right now, and that bodes pretty well for consumption going forward. I talked about the fact that the recovery and employment is not equal. What this chart looks at is the year-over-year employment roles. So which industries have more or fewer employees working right now? And you'll see year over year, we still had this huge deficit in leisure and hospitality. So huge gaps of people not going back to work yet in those areas. So a lot of these areas, there's still a long way to go to bring people back. And you've seen some employers have responded by increasing the entry-level wage that they offer employees. You know, last week you saw, I think, Burger King and a few other fast food restaurants are talking about increasing their minimum rate to $15 an hour. And that's to draw these people back into the workforce. Page 8, we're looking at inflation a little more closely, and we're looking at two numbers. So Robert mentioned Western CPI, and I don't know exactly which I or you or whatever. There are a whole bunch of different ways to measure inflation. But you see that number is coming in close to the broad CPI number here of 2.6%. But we also have this purchaser price index. This is how much you spend to buy things that you want to resell. And so that went up a lot. It's a little more commodity driven. And so you'll see that's 12%. But also keep in mind the rate of change, but also the level. We had about 2 years of negative CPI leading up to this. So we're really just getting back to where we were before to some extent. Doesn't mean that, you know, capacity constraint won't drive prices up higher going forward, but you need to keep that level in perspective as well. That last chart showed the yield curve increase, and that's pretty much what I showed on that previous chart, where we saw a really big back up in interest rates over the quarter. So that backup in interest rates led to a sell-off in the bond market. And so in the middle of this chart, you'll see the capital market returns for the fixed income market, and you'll see the average bonds were down about 3.4% in the quarter. So that's the worst quarterly return we've seen in 40 years for that sort of bond investment. Longer term bonds were down about 10% on average. So pretty tough bond market. You look at longer time periods, we're still looking at that 3, 4, 5% return you expect from a fixed income portfolio, but it could be a little bumpy going forward in the fixed income market. Other things to point out on this chart is in the U.S. equity market, on the top of it, strong returns for the quarter, up 6%. That 1-year return, keep in mind the starting point, positive 60% returns. And then the 5 and 10-year numbers are solid double-digit returns in the U.S. stock market. A lot of concerns about valuations right now, and so we shouldn't expect this level of return going forward. And then real estate is holding our own. We know we had a number of the real estate managers come in and talk to us about their portfolio and what they're doing to manage it over the quarter. The real estate market was up about 1%, last year up about 2%, so it's holding its own in where there are definite headwinds, and especially in certain areas of that market. The last thing I'd like to point out is, and it's pertinent to your portfolio, is that since November, there's been a huge rotation in the market from the stay-at-home stocks to the let's go back to work stocks. From the stocks that you're discounting earnings 30 years from now to what companies are actually making money today. So on the bottom right-hand chart here, the graph's a little hard to read because of the font size and all of that, so apologies for that. But what we're showing here are the gray bars are the returns up until November, and the green bars are since November. And you'll see that there's a huge shift here about winners and losers. And the things that are winning right now, at least this is through March, is energies, airlines, retail REITs, industrials, utilities. So a lot of things come roaring back. So what that means for your portfolio is that you have a bunch of value managers who invest in this area, and they're doing really well right now. And it's been good that we have continued to rebalance into these managers, take some money away from the winners, put it into the ones that have laggard, because we still believe in them in the long run. And that rebalancing has worked well for the plan. And so we'll continue to help you all do that. And of course, Robert does all the implementation for the actual rebalancing. So that's another big theme in the market right now that really flows through the performance of the portfolio. And with that, I was going to hand it over to Claire, who's going to talk about the actual plan.
Great. Thanks, Greg. So focusing in just on your plan and what all of that backdrop means for your plan. Frankly, there was actually kind of a lot that happened in the quarter. So 4 things in particular stand out. One, Greg already mentioned that returns for the plan were really strong, both at a total fund level and also looking at the individual managers and asset categories. The second is that the transition from or out of active large cap equity into the S&P 500 was completed. So as you know, we watched the majority of that happen, or the reports watched, Robert implemented. The majority of that change happened in the previous 2 quarters, but it was completed in January. So now the sole large cap equity, US equity investment in the plan is the passive S&P 500 index. The third thing is that the plan was effectively rebalanced at the end of March. Greg mentioned that equities continued to run and show strong positive gains, and that pushed the allocations to both domestic and international equity higher and fixed income lower as compared to the strategic target. So Robert did rebalance the plan to make sure that all of those asset allocations are back in line with the strategic target. And then the fourth item is that one of your infrastructure managers, to which you committed capital last year, did call that capital as of April 1st. So the cash was raised to fund that capital call at the end of the first quarter. So those are kind of the four big items, and you'll see that come through in the report here and the details that we point out along the way. Focusing on the page up here, page 18, at the top, we capture total plan growth over the last 15 years. And just as Greg pointed out, that yellow line tracking the return of the S&P 500 through the recent bear market and then recovery, the far right portion of that top chart captures what that meant for the Mendocino portfolio. So you can see the sharp decline and then rebound that really does track that S&P 500 index kind of experience. So again, just as the 1 year return Greg mentioned really does capture kind of that bottom to top of the rebound, you can see that in the asset growth of the portfolio on the far right there. The bottom half of the page looks at total plan growth and asset movements over the fiscal year to date period. So we've got 1 quarter to go in this fiscal year. And this looks at June 30, 2020, the end of the previous fiscal year, to the end of March 2021. So at the beginning of the fiscal year, the plan started with $538 million. Thus far through the fiscal year to date, the plan has seen an investment return of $133 million. Net outflows to pay benefits to the tune of about $7 million. And as of the end of March, the plan stood at just shy of $665 million in total. Now, if you look at the net new investment column, you can see those rebalances. So there was a fair amount of cash that moved during the quarter. Again, moving out of domestic equity and international equity into fixed income. And then there's a sizable allocation to cash as of the end of the quarter that was just temporary, raised from the equity managers to fund that JP Morgan infrastructure capital call, which occurred on April 1st. So again, that's kind of a point in time slice showing the $17 million sitting in cash. On the next slide, we look at actual asset allocation of the plan relative to the strategic target as of the end of the quarter. And as you can see, actual allocation was right in line with target. That's just what you'd expect, given that Robert had just completed the rebalance at the end of March. You can see that small 3% slug to cash, which again was temporary, and went to fund the JP Morgan infrastructure allocation as of April 1st. Now, notably, the board did adopt a new strategic target that incorporates that infrastructure allocation. So this is the last report that you'll see this specific target allocation as your target. As of April 1, we started to shift towards that new target adopted by the board last year. So if you look at slide 20, we've included what that means for the April 1st monthly report that you have. So given that only one of your infrastructure managers, one of the two, has called capital, so that's about half of the total allocation, the strategic target was adjusted halfway. So all of the changes to each asset category took that halfway step, and you can see what that means circled in orange and called the adjusted target. So that's the strategic asset allocation for the plan until the second manager, IFM, calls the capital committed to that strategy. On slide 21, we look at the detailed asset allocation. So among the different asset managers within each asset category, and how those assets changed over the course of the quarter. So focusing just on the recent quarter before we were looking at the fiscal year-to-date period. The plan started the quarter with about $643 million, saw investment gains for just the quarter of $25.5 million, outflows of $3.5 million to pay benefits, and then again finished as of the end of March, just shy of $665 million in total. Here you can see we still have the active large cap equity managers listed with the allocations going to zero. So again, the last slug of that transition to passive S&P 500 index for the whole of the large cap portfolio completed in January. You can see the detail of that asset movement in the top category, or the top portion of the page there. And then all of the details surrounding the rebalance. So out of small cap equity, out of international equity, and into fixed income. And again, that $16 million to fund the infrastructure JP Morgan mandate. Importantly, within each asset category, all of the styles remain in balance. So Greg mentioned the importance of rebalancing out of the winners and into the losers, out of growth, which has had dominated previously, and into value to capture the rebound that we saw in the previous couple quarters. That certainly showing through in the ending balance of style between growth and value within each asset category. On slide 22, we get to performance for the total plan. The total fund saw a return of 4.4% for just the recent quarter, the opening quarter of 2021, and that outpaced the strategic target return of 2.9%. It also landed in the very top of this peer group, which represents other public fund plans. For the trailing year, again, just looking at that recovery period, the plan was up 45%. So that's the total plan level up 45%. Outpacing the strategic target by about 9%. It was up 36.7%. Again, ranking very favorably versus peers. Longer term returns, 3, 5, 7, and 10. Solid double-digit returns on an annualized returns for the trailing 3 and 5 year time periods, up 11% over 3 years, up 11.5% over 5 years. And then longer term returns, 7, 10, and 15, up about 8 to 9% annualized, and faring very well versus the strategic target as well. Fiscal year to date returns are captured on slide 23. 1 quarter shy of a full 2021 fiscal year return. The plan is up 25%, just over 25% versus 20% for the strategic target. You have the April report in your hands, which we'll look at in a minute. Through April, the fiscal year to date return was up 29% versus 24% for the strategic target. And then on slide 24, we look at cumulative returns. So this is over the last 15 years. The blue line on this chart represents the Mendocino total fund, total portfolio, actual return. The green line representing the experience of the strategic target. So if you had implemented your strategic target fully with index funds. And importantly, the blue line does remain ahead of the green line, indicating that the active management within the plan, the implementation of the strategic target has benefited over time. And then on slide 25, we look at the total fund versus the strategic target in risk return space. So this is not a new result for this plan. The plan has returned higher, or has achieved a higher return than the target, and then versus most peers. but with a higher level of volatility measured by standard deviation. Now, as you know, the inclusion of the infrastructure allocation is to help dampen some of that volatility. So move those dots to the left, and we would expect that experience to come through over time as those mandates are incorporated into the portfolio. On slide 26, we look at attribution. So how did the plan achieve those returns that did outpace the strategic target? So on the top half of the page, we look at attribution for the recent quarter. And at the bottom half of the page, we look at the longer term 5-year time period. Circled in green is what we call the manager effect, or the added value of your active managers in aggregate for each asset category. And as expected, that's really what's driven the outperformance of the plan for each time period shown here. So asset allocation, again, Robert's done a great job of rebalancing back to the strategic target whenever those ranges are breached. So that tends to be a smaller contribution to variation from the target return. Again, manager effect driving the outperformance over time. So the recent quarter, domestic equity, fixed income, and international equity, the active implementation of each of those asset categories did add value, totaling about 1.13% over the return of the strategic target. Same was true over 5 years. The implementation of each of equity, fixed income, and domestic equity, fixed income, and international equity added to the total fund return, in aggregate adding about 60 basis points. The real estate allocation has certainly been additive, quite steady, returning about 2% in the recent quarter, as Greg mentioned, and really kind of a flat return from a manager perspective. The two managers that you heard from last quarter have done a nice job of managing those portfolios, the total return being pretty much in line with the index included in the strategic target. On pages 27 and 28, we look at the detailed returns for each of the individual managers in the portfolio. So on 27 here, we have the domestic equity managers. Again, only one line for large cap equity. That's in the S&P 500 index, and that's what we'll see going forward. Looking at the top line, the domestic equity portfolio in aggregate was up over 8% for the quarter, 8.3% versus 6.35% for the Russell 3000 index. So a good return for the total portfolio versus benchmark in the quarter. Over the last year, up 72%. That outpaced the Russell 3000 index return of about 62.5%. Again, capturing that rebound from the bottom to the top. Over 3, 5, 7, and 10-year time periods, returns for the domestic equity portfolio range from about 13% annualized to 17.5% annualized, and also doing well versus that index over those time periods. Over 15 years, the total domestic equity portfolio has returned an annualized 10.2% versus 10.05% for the Russell 3000 index. Within the domestic equity portfolio, you use your active risk budget within mid-cap and small cap. And those allocations have done very well for you, in particular in the recent quarter and year. So in the recent quarter, your mid-cap managers were up 13.8% versus 13% for the mid-cap value index, and 4.9% versus a negative 0.6% return for the mid-cap growth index. Again, over longer term time periods, returns for both managers remain complementary and quite strong. Most returns on an annualized basis are double digits. Within small cap equity, the Prudential small cap value portfolio is one that we've seen lag its benchmark for a number of years now. So the Prudential small cap value strategy is really a true value small cap strategy. And that style orientation has been out of favor for a number of years. With the changing dynamics in the market that Greg described as the kind of go back to work trade, value coming back into favor, we would expect this strategy to come back to outperform, and it has. It was up 27% in the quarter versus 21% for the Russell 2000 Value Index, up 135% for the last year. That's a pretty remarkable return for the last year, and it certainly narrowed the gap of underperformance over longer time periods. You can see that over 3, 5, and 7 years, the strategy does trail the index, which is what we'd expect from that factor, from that small value factor, which is what we seek in this mandate. There were a handful of organizational updates by Prudential in the quarter that we want to bring to your attention. So Prudential did let us know of a handful of personnel changes. So they've got 5 retirements announced that will be effective as of the end of the year, and they laid off a few people. So there's a change within the team there. Our research team has talked to Prudential a number of times, and the individuals specific to this portfolio. And among the names of folks that are leaving the team, there's kind of one that's most notable, and that's a fellow by the name of Peter Hsu. He's the co-head of quantitative equity at QMA Prudential. He is leaving the strategy and the firm at the end of the year to pursue other interests. So I think one of our key concerns in talking to him was, was his departure, was he pushed out based on financial concerns? And that's not the case. That's not our sense, and that's not what they've conveyed to us. So looking at the strategy going forward, I think key evaluations are that we do still think that the experience and the resources on the team are sufficient. We have confidence in them. And also that the assets under management at the firm remain stable. So one thing we want to watch with this strategy in particular, and given the changes that have been announced, is whether or not there are significant changes to the assets under management related to this strategy. We haven't seen anything notable as of yet, but it's something that we're watching more closely. So given the personnel changes, we wanted to raise that to your attention. We don't have any recommended changes to this strategy at this time. We do think it still fits well in the portfolio and provides a good balance to the AB small cap growth strategy. But again, it's one that we want to watch more closely given the changes announced. Rounding out performance for the domestic equity portfolio on this page, the AB US Small Cap Growth Fund was up about 3% in the quarter. That did trail its index. It's up 96% over the trailing year and has fared very well, outperforming its benchmark over longer time periods. Performance for the international equity managers, the domestic fixed income managers, and real estate are captured here on slide 28. Again, the total international equity portfolio fared very well versus its target in the recent quarter, up about 4.5% versus 3.6% for the benchmark. The last year up 64% versus 50% for the benchmark. Longer term returns are favorable as well. Within the international equity portfolio, the value managers fared very well in the recent quarter and year as expected, as that value tailwind came back. But again, the total portfolio remains well in balance and has worked well over the recent time periods. Domestic fixed income did see a negative return consistent with the broad markets. So as interest rates went up, that did push fixed income returns into negative territory. But in aggregate, your two managers, Dodge & Cox and PIMCO, outperformed the Bloomberg Barclays aggregate. Over the last year, the fixed income portfolio was up about 5.4%, handily outperforming that index of 0.71%. The fixed income portfolio is ahead of that benchmark over all time periods, shown here as well. And then real estate up about 1.8% for the recent quarter, just shy of the real estate benchmark, but again, turning in a pretty steady a 2% return for the quarter, 1.3% for the trailing year, providing diversification to the total portfolio through the volatility that we've seen in the last 5 quarters in particular. Total fund returns we've already seen, but captured again at the bottom of about 4.4% for the quarter versus 2.9% for the total fund benchmark. And then the last few pages here, I'll get through pretty quickly. They look at performance for each asset category versus benchmark and peers. So here we have the return of the MSERA domestic equity portfolio versus the Russell 3000 index and compared to domestic equity portfolios of other public funds. As you can see, the blue dot representing your portfolio sits at the top of that peer group and ahead of the benchmark overall, or just about all time periods shown here. So very strong returns out of the domestic equity portfolio in both recent time periods and longer term history. International equity is captured on the next slide. Again, the blue dot representing the Mendocino portfolio lands well ahead of the benchmark over the trailing year and really again at the top of the peer group, ranking 9th among peers, and again turning in a return of about 64% versus 50% for the MSCI ACWI ex-US index. Over longer time periods, the Mendocino portfolio international equity asset category has landed about median among peers over the trailing 15 years, up about 5.5% versus 4% for the index. Fixed income is on slide 31. Overall time periods shown here, landing around median among other fixed income portfolios of public funds, ahead of the benchmark over all time periods. One thing that you'll note here is just the range of returns in the last year for fixed income portfolios, ranging from about 1.3% to 10%. So that's certainly much broader than we see over time as expected. A more normal range tends to be within about 3%. And then lastly, on slide 32, performance for the real estate composite up 1.28% for the last year, and ranking about median among those of other public fund peers. Are there any questions on performance? I think overall, we're pleased to see continued strong returns from the program. And we've got the April report up as well, which is a continuation of those themes. So strong positive returns out of the equity portfolio and benefiting the total plan as well.
Great. I'll pull up the monthly return in a sec here, but just wanted to let you know, some of you may know that we're holding our national conference in July. And our clients can attend that both virtually and in person. We are requiring vaccination if you do decide to attend. And there are going to be a bunch of outdoor venues there. So we are looking to do that in July in Salt Lake City. If completely understand that it's a ways to go. And also people are not, some people are not comfortable going in person. So we have the virtual format. If any of you want to listen to the speakers, listen to our research that we're presenting in July.
Thanks. I'll definitely be there virtually.
That is great. You know, one other thing is kind of topical is just wanted to make sure that you're aware that as you build out the infrastructure investment, JP Morgan called their capital. We're in that. The second manager is named IFM, and they have yet to call the capital. But just to let you know, one of their holdings is the Colonial Pipeline that you've been reading about in the press. So they are a minority owner of that pipeline. What's it, like 15%, Claire, ownership? So you've probably been following that in the press, how the operating company, which they own, paid the ransom to get the oil flowing on the East Coast again. So I just wanted to make sure you all knew that was one of the portfolio holdings. We're not in that investment yet. We made the commitment to give them capital at some point, so we're not exposed to it, but it is one of their portfolio holdings. Okay.
Looks like Gary has a comment. She's muted.
I just want to say kudos to Callan for tremendous returns, and to Robert and the whole team. To be able to see this kind of progress is definitely heartening and makes me a very content board member.
Thank you for that, Jerry.
Yeah, you know, one other thing I wanted to mention, actually, just about IFM, I did speak with them, and I got a little more info on where we are in their queue. We are not going to have any capital called in 2021. We are in the next capital call queue that's going to be next year. So there's a capital call in December. We are not part of that queue. We're going to be in the following. Any other comments or questions on the investment reports?
So the one other item is we'll just quickly look at the month of April. Month of April assets stood at $683 million, about $20 million in investment gains. If you look at where the gains came from, it's kind of across the board. Both stocks and bonds performed well in April. So the sell-off in the fixed income market, interest rates came back down a little bit. So the fixed income assets appreciated a little bit. And then in the stock market, it continued to run up. We hit all-time highs in the stock market a couple of weeks ago. Since then, we've lost a little ground. And then today, at least last time I looked, we were down about 1.5% today. Big sell-off in cryptocurrency today too, which is definitely grabbing some headlines. And just for the record, we had no exposure to crypto. And then for the month, I'm sorry to move this around so much. So for the month, the total fund is up about 3% for the month of April, a little bit behind the benchmark, but keep in mind, we don't get monthly performance for the private assets, so the real estate and infrastructure. So once we get those, but we have a benchmark return for them. So once we get those numbers in, we'll probably close the gap, and we probably came in pretty close to benchmark returns for the month of April, up about 3%.
Greg, earlier in your presentation, you touched on inflation, and I read an article about lumber prices and how they'd shot up so much. And it was unclear, at least the author of the article was unclear when exactly they would start to stabilize and kind of normalize. What is sort of your summary of what you think is going to happen with inflation?
Well, so I think there are a few things driving inflation right now. Some of it is supply. There's limited supply in things that we need to build other things. And so lumber, right there, you get it. Over Mother's Day, I built a planter box. And that was the most expensive planter box I have ever built. It was shocking. I went to Home Depot, bought this redwood, and the price was kind of crazy. The same thing goes to computer chips. You'll see that the Intels of the world, the Qualcomms of the world, they don't have as many chips, and it's affecting the auto industry right now. And there are a lot of chips in cars. So and then there's also a certain shortage of labor, supply of labor to certain businesses. Now, some of that labor is the $15, $20 hourly labor that is not coming back yet, but that's pushing up prices because there's restricted supply. So the restricted supply driving inflation is something we need to keep an eye on. But I think a lot of economists believe that's the component that is transitory. You hear people talking about transitory inflation, where, okay, we'll figure it out. We're going to get the lumber mills will get going again. The supply of lumber will get better. Chips will start being produced, and the distribution of these products will get back better, and then that inflation will come back down. So there's a transitory component to it. There are other parts of inflation due to, monetary and fiscal policy that could be longer lasting. Frankly, I believe asset inflation is an inflation component that is probably underreported. The price of homes, the price of stocks, the price of bonds, that is inflation in itself too, right? Being driven up by a lot of money being out there, right? Inflation is driven by excess, a lot of money and fewer things to buy. That's what drives inflation. And I think there has been some of that, you could argue, in the capital markets too. I don't know if that directly answered your question, Dan, but.
Well, it sounds like you don't have a crystal ball like anybody else does about inflation, but.
No, but we are in the camp that there could be higher numbers in the short term, that you have to look at the level of inflation, not just the most recent growth rate. And then over the long run, it should come back down. It should be transitory, and it should come back down to a more reasonable level, because there are a lot of deflationary factors too out there. Technology is deflationary over the long run. You can do more with less with technology. So that should be deflationary in the long run.
Okay. Thanks, Greg. Jim?
Yeah, Greg, you mentioned chips, and I thought that was an interesting one, because with all of kind of the geopolitical stuff going on with Taiwan and that particular area, and then homeland security issues, the Colonial Pipeline, I mean, everything in the news, really, when you drill it down, it goes down to the chips. And I'd heard from a number of sources that we're probably 3 to 5 years away from having the capabilities to have high quality chips available for all of those manufacturing and other sectors that rely upon them. And I'm just wondering, what that does to, investment and return potential in those industries, and if you guys are taking that into consideration.
You're getting deeper than I know with that, Jim. So what I hear from that is restricted supply, which will drive up the price of chips, and could reduce the production of certain things you might want to buy. Whether it's a car, maybe some cars will have fewer chips in them than they otherwise would. The auto manufacturers is still going to produce that F-150, but it might have fewer chips in it, which means fewer gadgets and that sort of thing within the car. That's a great point, and something to certainly keep an eye on, Jim.
Okay, any other questions? Doris, Robert, do you have any final thoughts or comments?
Well, to try to answer your question a little more concretely, I'll go out on a limb and reiterate again. I think the U.S. Bond market is the place to be for international investors, and that's a spot that we need to watch long term. Just because if it's hard to, when that flips switch and international foreign fund investors are not able to have those allocations, be confident about them, then we really have the beginnings of some problems. So that's not happening probably anytime soon for a few reasons.
Okay, well, does this conclude these items?
Yes.
Okay, great. Well, all right. Well, thank you, Callan. And I guess that takes us to the quarterly budget update. Or did we have any public comments on this item?
I see no public comment at this time.
Okay, thank you. All right. Okay, thanks.
Good to see you all. Thank you so much.
Thank you.
Bye-bye.
Thank you, Greg, Anna, Claire.
Thank you. All righty. So we are moving on to the quarterly budget update. You should all have that in front of you. It's got the typical notes on it, which I'd be more than happy to run through. But I wonder if anybody had any questions or concerns or line items you'd like me to focus on before we start. Did anything jump out for anybody? Okay, not hearing anything. Let me just briefly run through. Let me run through 1B and 2B just real briefly. 1B is going to compare our year-to-date actuals with last year's actuals. Overall, we were down quite a bit, but I guess starting up at the top in the administrative subsection, we've got a sizable difference in legal. Last year, there was a large ramp up in those expenses, as the board's aware, in preparation for for a number of projects that we're continuing to work on. The consulting actuary line item kind of pops out just because of its new location in the report. In previous years, that was down in the investment subsection in entirety. So again, the board is aware of that. It looks a little funny, but that will change next year. So next year's reports will look a little bit cleaner and more easier to to compare visually. The second big item there is contracts. Last year, with Dr. Wilbanks leaving, we had a search firm employed for the new executive director. So that's the big difference there. Training and education, again, the board's actually done a fair amount of training this year, but a lot of that training has been at a lower cost, and it hasn't included actual travel. So that's the reason for that large difference there. Continuing down on board expense, fiduciary insurance, again, the board's aware that number went up quite a bit primarily due to experience. The disability section's always very hard to compare, so I'm really not even going to attempt to go over that in too much detail. I'll move down to technology. The County IT expenses have been a little more expensive than last year. That does make sense. We've spent the majority of this year doing things remotely, and as we have made tweaks to our systems and exactly what we need in terms of equipment, software, and connectivity, that dollar amount has increased over last year through this same period. The investment subsection, primarily an increase in the manager fees. The returns have been very good for the last year. Those returns are based off of TRO 91 and Mondrian. Those funds have benefited over the last year quite a bit. And so we had to pay more than the prior year. As the board can see through April, it's still a fairly small dollar value overall. The custodial bank is also lower than compared to last year because last year I had begun the accrual process. So I'm accruing much more than the previous years. And part of that is that began last year. So this year we've got nice accruals going on month by month. But the prior year we had 3 extra payments in there. So that's the big difference there. And then that actuary Siegel line kind of just looks different, again, because part of the funds are being reported up in the administrative subsection. Let me move on to 2B. This is our year-to-date versus the budget. Overall, we are below the budget in just about every category, subcategory, I guess, in terms of subtotals. Somewhat to be expected, our technology and investment subsections are closer to the budget, just in general. But let me start up at the top. The big savings that we see dollar-wise are our personnel, legal expense, and our staff training. Staff training, no surprise there. COVID, the lockdown. Legal expenses have been a challenge to predict. And so we do have a little bit, what appears to be a little bit left over. I'm not so sure that will actually precipitate through the end of the year. Personnel is lower than the budget, essentially due to timing. I do expect that to come in probably around less than 7%. So we will make up that $40,000 gap. It'll probably get down to less than $10,000, depending on how much overtime we work over in the next 3 or 4 pay periods. Continuing down to board expense, we see the big fiduciary insurance. That was somewhat unexpected. That's the large increase there. Again, we see board training as lower, same thing as staff training, lockdowns, lack of travel expenses, essentially. As we keep going down, again, I'm going to skip over disability. We've kept that disability primarily the same, and it's somewhat hard to predict and track. Moving down to the technology, we can see that there's a slight increase in the PCX scan station. That's contractual. And we can also see a slight savings in LRS and county IT. LRS, we may be very close to the budget, possibly just under, not 100% sure. We have a lot of expenses accrued right now. There are a few more in April. So I do expect the technology section to be close in general. County IT expenses are also just below. It's kind of hard to say where that's going to come in exactly, depending on when we reopen. If that happens, we could potentially, lower some of those that budget number in the future. Investment subsection may end up being relatively close also to the budget, mostly because the management fees, now that I've spoken with IFM, we know that we're not going to pull any money out of Mondrian. So Mondrian is going to probably have a large balance going through the end of the year. I was hopeful maybe that wouldn't happen, but it will. The custodial bank fees also, just by virtue of having such a large asset under management increase, that's going to push up our billing. So it is likely that we'll be busting that budget a little bit. It's primarily because of that increase in assets under management, which, we're actually happy about that, I think, especially considering last year. Overall, we're about 24% below the budget at this point. But you can see our technology and investment subsections are going to be right at or possibly a little bit over budget, depending on what happens in the next few weeks here. And those are some basic highlights. Does anybody have any thoughts about any of that? Comments?
Looks good.
Yeah, thanks for the explanation, Robert.
I don't know if that was too long and droning, sorry.
Okay, well, I guess that takes us to the discussion possible action regarding the proposed fiscal year 2022 budget.
Thank you, Chair Jurdy. I'll make a couple of introductory comments and I'll probably let Robert take it over from there. There are a couple of significant changes to this year's proposed budget. One being the request for an additional staff member, which we did include in the budgetary figures. Also, the Information Services Department with the county has changed their cost allocation methodology that has increased our IT expenses going forward. And we do expect to have some additional IT expense relating to services from LRS in support of pension goals for a range of topics. If you have any specific questions, Robert or I am happy to answer any questions. It is notable that this budget puts us above the 21 basis points of the AAL that was the board's policy, but it still comes in below the $2 million threshold that is permitted under the state county retirement law.
Okay, yeah, Jim.
Yeah, a quick question on that for Doris or Robert, probably Doris, is I know that threshold has been in place for now more than a decade, and it looks like we're getting close to bumping up against that, especially with increased personnel costs. Has there been any discussion about any updates to that or any legislative amendments that would recognize kind of the duration of time for small systems living under that threshold?
I believe, if I recall correctly, which this was before my time, but that I had heard that initially it was 21 basis points of the AAL, and that to accommodate smaller systems, they put in the $2 million cap. We're still well below the $2 million cap. I want to say it's 400,000 or 500,000 below that. Let's say 399, 400,000.
311.
But we're over the 21 basis points by just a little bit. And some of the expenses, like extra help, may go away, and we would probably fall right around that 21 basis point cap. But at this point, we're proposing a budget that exceeds the board's policy of 21 basis points, but we still are below the cap allowed by law.
And I was mostly looking at the trajectory of salaries and benefits, and I know that there was a salary study done. I don't know if that's going to start to level off at this point. I was just wondering about kind of that gap that's been closing.
Some of the past salary increases related to that cost study that the county did have basically come through, and those increases will go away with this coming fiscal year, I believe, and Robert can correct me on that if I'm wrong. The other item that you asked about is whether or not there's been any discussion about having legislative action to modify the CIRL to provide a higher threshold. And there is none that I'm aware of. We can certainly look to SACers and for assistance on whether or not there should be any a request to modify the CIRL, because SACers is our legislative organization that supports systems in that regard.
You know, one thing that I also alluded to here in the personnel section is that the auditor's office does provide the personnel payroll amounts. They've included the final year of the cost increases in that projection. I've included some supplemental dollars there, 3 to 5% for the new position and possible changes that we're not sure if they're going to go through the Civil Service Commission, what the Civil Service Commission will say, or what HR's process and response is going to be to that. So that's part of what that number could potentially be high for salaries. It might be less than that.
And Robert's comments reflect that we expect that there may be some salary changes with the classification study, but HR has not been able to provide us with those figures at this point. I would expect them within the next week or so, and we can certainly bring back an amended budget if necessary, but he built in a little bit of cushion there because we did not know the effect that the reclassification study will have on potential salaries for those reclassified positions. We have the Civil Service Board meeting this afternoon. It would be scheduled to go to the Board of Supervisors. I believe it's June 22nd.
Okay, thank you. Catherine?
Yes, I don't have the history of the policy about the 21 basis points, but I don't know, I'm reluctant to intentionally make a decision that goes against a board policy. So if the board is looking at adopting this budget, I think we should probably look at the policy and make it agree to the CIRL law or something, because I just, sometimes we don't follow policy unintentionally, but I hate to intentionally not follow policy.
Maybe that's a question for Jeff. Is that something that we could take action on at today's meeting?
May I state what the policy says in this regard?
Go ahead.
In section 3, item number 3, it says administrative expenses of the association shall not exceed 0.21% of MCERA's actuarially accrued liability unless authorized by a separate vote of the Board of Retirement. So I interpreted that if the board voted to adopt the budget that was in excess of 21 basis points of the AAL, that fulfilled the requirements of the policy, but Jeff could speak to that as far as whether or not it needs to be separately agendized and adopted.
So if I understood that correctly, and Doris and I have not discussed this until right now, it sounds like if you take action, you will be consistent with the policy. But as Trustee Smith was suggesting, sorry about that, maybe you want to revisit that policy, but it sounds like you can act consistently with that language.
And that clarified it for me too. I appreciate you reading that language. I also, we've talked a lot about the additional work and the workload and all of that. And I agree that we need somebody now. I just don't know whether that's going to continue for the next, 5 years, 3 years, whatever. So I just want to make sure that we revisit staffing in the future after we get through this project mess.
Certainly, there are a number of areas that I think we would like to expand services to, but additionally, this gives us some depth of bench to maintain our service levels if we have staff transition, and there had been talk that people may want to leave MSARA to move out of the area or retire. And this would allow us to have some staff to absorb that workload if the situation changes. There's a number of areas where like I said, we would like to see an expansion of services to membership to provide more pre-retirement seminars and mid-career seminars to active membership. So if we have staff and as the project work decreases, we'd be looking at restoring and then increasing the services we offer to membership.
Great, thank you.
Just to ask, relating to the 21 basis points, where does the $2 million threshold come in? Is it in that same policy? Is it an either or thing, or is it a both thing?
In the county employees retirement law, it allows a administrative budget of $2 million, or you can pick one that is 21 basis points of your AAL. When I was with Fresno, for example, they had a much larger liability for the plan. Their 21 basis points was in excess of $11 million and covered their administrative budget with lots of room to spare. Being a smaller system with a smaller plan liability, we're now looking at our liabilities are such that it would come in right around the 1.6 million ballpark for 21 basis points, and we're slightly over that, but still below the $2 million as a cap that's in the serial, and you could use either one that works for your system.
I understand. So the one is in our policy, the other one's statutorial.
Correct.
Understood. Thank you.
And it looks like they're both caps. So it's the larger of the two, basically.
Sherry?
We could maybe check with Catherine or have Catherine check with Sackers, because I know it used to be 18 basis points and that I think that's what it was. And then it went to 21 basis points. It seems like the logical move down the road here within the next year or two is that might get bumped up again. And then we would fit within that limit. So
I would be happy to do that today.
Thank you.
Well, I think as others have said, it seems like we have some extraordinary expenses with the project that warrant going over the 21 basis points. Personally, I don't think I want to say that we'll forever be over the 21 basis points, because I don't think that's true. And so anyway, so maybe we could adopt the budget with some recognition of the extraordinary expenses that we're incurring in these years.
Are you looking for a motion?
That would be helpful, yeah.
Well, then I will move to adopt the budget as proposed for the fiscal year 2022, with the understanding that we will revisit these expenses every year annually. and fit within the policy guidelines.
I'll second that.
Okay. Judy, do we have any public comment on this item? Okay,
No public comment at this time.
Okay.
Sorry.
Thank you. All right. Okay, can we have roll call?
Yes. Ms. Shatmeyer,
Yes.
Ms. Cavanis,
Yes.
Mr. Dirty,
Yes.
Ms. Smith,
Yes.
Mr. Cromer,
Aye.
Mr. Shoemaker, Mr. Shoemaker. Okay. Ms. Harris,
Aye.
Mr. Anderson,
Yes.
approved.
Okay, all right, thanks. That puts us over at the discussion regarding administrative report.
Thank you, Chair Jurdy. One moment, please. I apologize. I had closed items when I was looking for the board's policy, and I lost my administrative report. So just a reminder that my 1 year of employment is coming up, and it's time for my evaluation process. I believe Vice Chair Smith sent out packets to the board for an evaluation of my performance. Those packets she provided a due date will be returned directly to her, so that will be included on the June agenda. The other operational item is that as COVID restrictions are reduced, at some point the governor will be eliminating the state of emergency that permitted these Zoom meetings in the format we're currently holding them. We will need to make some decisions about how we would like to move forward once some of the restrictions are lifted. I did read something saying he would give a couple of months notice or so that it was going to be lifted to allow boards the opportunity to work out the details, but I just threw a few of them out there in the administrative memo for your review. There also is a legislative update from SACRS attached to the administrative report today. If you have any questions, I'm happy to entertain anything that you'd like to talk about. Ms. Harris?
Jerry?
Personally, I would like to see us get back to in-person board members as soon as possible, not only because of the project and dealing with people whose lives have been upended in some ways. I think that face-to-face is the way you handle things in a situation like the project when people have concerns and need to appeal. And frankly, I'm over Zoom. I'm really tired of trying to get things to work and trying to get an iPad that has been a big challenge that even Judy recognizes. So I would like to see us move back to in-person meetings as soon as possible.
I did ask Judy to research whether or not there were any alternate facilities that we might be able to use that would allow us to return to in-person meetings and still provide some social distancing and also allow and incorporate the opportunity for public attendance. Our boardroom is so small, that conference room is completely full with just the board in there and can barely fit any members of the public as it is, and there would not be an opportunity really for social distancing with that meeting room as it is currently laid out. I have not looked into other mitigation efforts, but I figured we didn't probably want to move into putting up plastic dividers between all of the chairs, which is what some systems have done with their boardrooms, but we are looking to see if we can find an alternate venue that might accommodate some social distancing as restrictions increase, but there still may be some restrictions in place.
I'd like to just add to that I've been on the search for an alternate location, and Wednesdays are extremely popular meeting days. So most facilities are telling me no. IS is also suggesting that they will not have the staff nor the equipment to provide to record our meetings and or broadcast them like we've been doing since we have started using Zoom. Then there's also a fee to rent a space. It's been most difficult finding a free location. So if those items are important to you, please let Doris or I know, so that we can make sure that we're finding the right location for you.
And hopefully we'll have a couple, 2-3 months here to work out the details. I'm sorry, Chair Judy.
Well, just on that point, I'm wondering about, Judy, if you've contacted, I don't know, say the Ukiah Veterans Hall, which is a county-owned building. I mean, there's some, I'm just trying to think of some buildings that aren't normally used for meetings. I think buildings like that are sometimes used for evening meetings. Mm-hmm. And maybe if the board was open, we could meet on, say, a Thursday morning or a different morning of the week.
Well, for example, the Veterans Hall is open for our June meeting. However, IS is telling me the acoustics are so bad in there, even if they were able to provide a staff person to record our meeting, not broadcast, that the viewers could not understand what we were saying, and there is no Wi-Fi available in that building.
So if I may just add, I mean, there are a lot of complications with moving to an open meeting. And I think there probably would be requirements. I mean, the last comment Judy just made, I think you're going to be required for some period of time to allow for folks who want to comment remotely. But Cal OSHA, for example, has a meeting tomorrow, and they're considering new regulations that may change social distancing requirements and masking requirements that are linked with whether or not people have vaccinations. And it's an area that's in tremendous flux, and there are all kinds of questions, and all these public agencies are grappling with how to move forward. So we can take our cue from some other jurisdictions and work along a parallel track. And we definitely have an issue with a very small conference room that we meet in. So there's just a lot of challenges right now. I just wanted to point that out.
Okay, thank you. Richard?
Yeah, just if I could have my video unmuted. There we go. That's all. I will say that if there is a device called a meeting owl that can be used for Zoom meetings that allow people to participate elsewhere, and not everybody in the meeting room has to have a computer and a camera in front of them. So as we move into the hybrid style of meetings with some in person and some by video conferencing, that is a piece of hardware that works reasonably nicely for that.
Thank you for that suggestion.
Okay, appreciate that. And just as people aren't aware, it's likely the board of supervisors won't be meeting in person until maybe September. And it's not even a sure thing that all 5 of us will be meeting in Ukiah. We might be doing something, as Richard said, where maybe 3 are in person with the chambers open to limited public audience, and then maybe a couple of us are zooming in from the coast. So, but anyway, so I agree. I think there's a lot of thought going into how to make the meetings more in person, but they may be a hybrid system that people go with. All right, well, thanks for your report. Yeah, did we go over you referenced the legislative update. Any questions on the legislative update, or did you want to go in more detail on that, Doris?
I did not have any specific comments to address the legislative update. These are bills that are pending. If you have comments regarding any of the bills, we can look into whether or not you want to make a motion of support for anything in front of the legislature. Right now, there is a motion on the AB 703, which is continues an option for virtual meetings beyond the pandemic. So that might be something that is addressed legislatively going forward that would allow those hybrid meetings without all the other requirements that are contained in the Brown Act as far as remote participation by a board member.
Okay. Any other comments on the administrative report? Do we have any public comments on this?
No public comment at this time.
Okay, all right, that takes us to general board member discussion. Do board members have any other items? Kathy?
Yeah, just a couple things. I just want to make sure that everybody got the email with the executive director evaluation. And so you've got the forms to fill out there. And then the second thing, I just wanted to report that last week on Monday, I did do the virtual CalPERS trustees roundtable. And it was quite interesting. They spent the whole morning with a panel talking about the pension reform in Canada. And Canada is a few years ahead of us. And anyway, it was really interesting. It had some history as to how we got into the unfunded situations that we are in and how Canada's worked their way out of that hole. So, and then in the afternoon, they had a panel talking about how important it was for public systems like ours to get involved in the lawsuits when there are securities fraud, because it gives a lot of weight to the side trying to get the companies to pay back, the money that they were frauded out of or whatever. Anyway, I thought, oh, I don't want to get involved in any lawsuits, but that was what the afternoon was about. But it was a good conference.
Thank you. Richard?
I apologize. I had to step out for the meeting for a minute for an emergency call. So I don't know if this topic came up. The appeals that we are hearing, that this last one that was scheduled during this meeting with an open discussion of the appeal and then a closed session. I was wondering if there was any opposition, either legally or by board members philosophically, about those occurring in closed session due to the possibility of personal information and appellant privacy issues. It would seem to me that having to lay it all bare out for the world on Zoom and Facebook and every place else is probably not the best way or the best thing for an applicant or an appellant to have to do. That's my kind of question and comment.
So if I may jump in through the chair. So this is not really it's not an agenda item, so we really can't get into a discussion. But if the board wants to give, because we have discussed how appeals would be handled in a prior meeting. I'm not sure we quite touched on this issue, but I'm happy to, have some communication on this issue with the board or as an agenda item. But I'm not sure that this is the appropriate time and place to talk about that.
Well, I guess I have a question. So Richard, have you had a chance to maybe raise more specifics with Jeff or Doris?
Doris did a great job on a short-term discussion early today. It just still is an issue that I'd love to ask a report back from staff, or again, if the board wants to take an action later to say yes or no to it, to do that. I just think it's something that should be feasibly explored for feasibility.
Okay. Doris or Jeff, do you guys have any response or thoughts?
Well, I mean, I do, but I feel like this really hasn't been agendized. So I'll just comment briefly that I'll just share that there are some systems out there, to frankly my surprise, that conduct disability retirement hearings in open session. I mean, I can't imagine a more confidential, private matter than those kinds of issues. Benefits appeals, to my knowledge, across all systems are done in open session. I'm not sure what the hook would be to have that heard in closed session, but I'm happy to provide some further information on it. But I just don't know what the hook would be. The hook for disability retirement matters is privacy of medical condition. Although, I think that that's why there are some systems who feel like there's not even a proper hook for that, and they just do it in open session. But I'm happy to talk with staff, and I don't know if you want this agendized as a separate issue, or we can handle it some other way.
Well, I know you guys are busy, but maybe there could just be, I mean, you've given a verbal report, but maybe there's a little bit more that you could provide at the next meeting, just on the rationale for why it is done in open session at our system and at other systems.
Sure, and maybe it's part of the standing item we have on the project, or maybe a separate item. We can talk about that.
Yeah, sounds like it could fit into the standing item. Okay, great. Well, thanks, Richard. For any other board member items? Okay, not seeing it, then we are adjourned at 10:08. Thank you, everybody.
Thank you.
Take care.
Thank you.
Bye.
Take care.